Welcome everyone. Welcome to the webinar on how to build a portfolio of funds and investment trusts. My name is Simon Molica and I'm a fund manager here at AJ Bell. Just a little bit of housekeeping first. You can ask questions at any time during the presentation. There's a question box for that, and that's in the control panel on the right-hand side. These questions can only be seen by us, and a selection will be chosen to answer at the end of the presentation in the Q&A session. There will be feedback forms though, so please do re-ask your questions on those forms if you do want us to come back to you and we hadn't had time today. Now, if there's any technical issues, these should also be reported in the question box, so please use that. And just so you know, an email will be sent about an hour after the webinar asking to fill in the feedback forms and information on how to download today's slides. Of course, as ever, if you don't receive the email, then please do check your junk folder box first. Otherwise, do contact us and we'll look to resend. Now, the session is being recorded and a video will be available on your website at some point in the next 2 weeks. Now, the next thing for me to do is just to read through the disclaimer, so please bear with us for a minute or two. So the value of your investments can go down as well as up, and you may get back less than you originally invested. We do not offer advice, so it's important you understand all the risks involved. If you're unsure, please consult a suitable qualified financial advisor. Tax treatment depends on your individual circumstances and rules may change. Now, past performance obviously is not a guide to future performance, and some investments do need to be held for the long term. Great, thank you. So maybe just a few words before we actually go into the core part of the presentation. So I want to kind of share with you a bit about my experience. So I've been in the investment industry for 15 years. I joined AJ Bell a couple of years ago to help working within the investment team building investment solutions. Now, I guess when I came out of university originally, around about 20 years ago, I started to do, a sensible strategy of saving money regularly and then using lump sums to buy funds. I guess that's the first tick in the box. But maybe the mistake I made was I would buy a fund purely in isolation. I'd look at a fund, I'd do a little bit of research. Back then it wasn't a lot of research, but I did a little bit. When I was happy, I would purchase a fund and I'd broadly kind of forget about it and then move on. The next time I had a lump sum, buy another fund. Now, what I never really did was actually consider how those funds would operate together. Now, fast forward to today, I've now got 20 years of investment industry experience. Now, I kind of understand the importance of thinking of things as one. So all your assets, your wealth collectively, and how they work together to meet your long-term objectives. So I hope this webinar really does address some of those issues and helps you to think a bit more about a portfolio in total. Now, the second point I want to make is that, sadly, investment should be boring. And there's a very famous investor, George Soros, who really states, if you're having fun, you're probably not making money. Good investment is boring. And we're big advocates of this message. If you're expecting from today's session some stock insights, some technical analysis, some real kind of drama, some short-termism, then you're absolutely in the wrong webinar. I'm really sorry to say. What we believe in is setting out a long-term strategy to meet your financial goals. And that's really what we want to focus on today. So without further ado, let's get into the webinar. So the first thing we want to talk through really is investment management steps. So what we think this can determine the difference between success and failure. So the first thing we think that's incredibly important is building a framework to operate within. You then need to understand the importance of asset allocation and determine your asset allocation. At that point, you need to consider the implementation route. How are you going to put your money to work? What investments are you then going to select? You then need to research those appropriate investment vehicles in order to help you select them. Then construct the portfolio. Like I was mentioning a moment ago, think of it as a portfolio. Think of it holistically. And then finally, you really need to monitor and review your portfolio. Now, again, advocates of long-term sound investment strategies, monitoring and reviewing can be frequent, but don't be tempted just to keep changing things for the sake of it. Now, laying those strong foundations. I'm actually in the middle of a extension on my property. Now, clearly what I did was follow some very sensible steps that you'd have to do when you do any building work. So I employed an architect. The architect drew some plans up. He spoke to a structural engineer. The plans then went through building regulations, got signed off for planning. I then spoke to a builder who then has started the work. Now, investment management should be absolutely no different to that. You should build a framework to work within. It astounds me how many people don't consider a framework to be important. They just want to get involved in the markets, buy and sell, and it's just so important to have that framework. Now, within that framework, what you should look to do is set up some parameters, some guidelines for you to work towards. So these guidelines may suggest how long you want your money invested for, what kind of time frame you're operating on, what your goals are, really what you're trying to achieve, the types of exposures and limits that you're willing to adhere to. So once you have your asset allocation, how far are you willing to let that run? How far are you willing to be overweight equities? And then when should you bring it back? So those types of guidelines we think are incredibly important. Now, what I'm really referring to is something known as an IPS, an investment policy statement. And in the industry, it's what we work with our clients to set out what the investment should look like and an agreement so that everyone's on the same page and we understand what our long-term goals are. Now, part of that is developing a clear investment philosophy and a well-structured process that you can follow time and time again. Now, here on the slide 4, I've got a couple of examples of pillars, principles you may want to consider for your own investment philosophy. And these are certainly ones that we use similar ones within everything we do. You may want to add in a few others, etc. But diversification, cost aware, I'm going to touch on them a little bit later on in the presentation, but long term. So what do we mean by being long term? We really believe in everything we do as being long term, and we can back up some statistics behind this. If we look at, say, the FTSE 250, I was reading about a research paper the other day, and it showed that over 30 years per annum, that index delivered around about 11%. Now, taking out the best 10 days within that period, we're talking about just the best 10 days of performance. So by no way could anyone expect which 10 days they would fall on. You actually lost 2% per annum. And when you compound that up over 30 years, that's an incredible number. If we take out the 20 best days, it falls again by another 2%. So this really can determine a different return profile. Now, you can try and forecast, but to really think you could be able to find those best 10 days or best 20 days is really not a game that we like to be involved in. So we do believe in being fully invested in the markets over time. Now, I guess once you've got your philosophy, your parameters set, the last thing you need to do is just follow them. You've written them out for a purpose. Don't be tempted to steer off course. Just adhere to your investment philosophy and process that you've designed. Now, I want to mention a little bit of a word on behavioural finance, because this is all about adhering to your philosophy and process. Now, behavioural finance is really defined by the study into the kind of psychological decision making of finance, so how people make decisions, and it really is driven a lot by emotions. So the person pictured here is Benjamin Graham, very famous investor known as the father of value investing. Now, he wrote a book called The Intelligent Investor in 1949, and I think it's a very good book for people to read. It really probably should be one of the first reads as a inexperienced investor who wants to learn. Now, one of his quotes is one of his very famous quotes, and I want to read it out for you, is the investor's chief problem, even his worst enemy, is likely to be himself. Now, I think what's really good about this quote is the fact that Benjamin Graham said this so many years before behavioural finance really became a thing, before there was much academics work on behavioural finance, before behavioural finance was even coined a term. Benjamin Graham said this because he understood what it was to be an investor in the markets and not steer off course and not be tempted into the new fads, and just keep a sensible strategy in place. Now, behavioural finance itself kind of counter arguments against the efficient market hypothesis. So the efficient market hypothesis tells us that markets are efficient, i.e. stock prices don't ever move away from their fair value. All information is within the stock price. Well, actually, behavioral finance argues against that, and it suggests that it's all about emotions and biases that move stock prices to overvalued and undervalued territory. Now, looking at it in a slightly different way, this is the investment cycle. It's the emotional backdrop to how we think when we're investing in. And I think it's important to bear in mind that we always consider history. It doesn't repeat, but it does rhyme, i.e. patterns do reoccur. And if you enter into a stock position, I think it's true for all investments. It's probably more extreme, say, for an AIM stock or even Bitcoin, if you like. But this is the kind of feeling we get, the optimism when we enter into the investment. And then if it does well, we get the excitement and the thrill. We pat ourselves on the back. We think we're incredibly clever. We don't necessarily consider it to be luck. And then we get up to the euphoric, where maybe that asset price is just priced so incorrectly, but we just don't see it. We just think it carries on. And I think, at this point, we'd be really good just to remind ourselves of Stein's law and the idea that if something can't go on forever, if it can't carry on to infinity, then actually it will stop. Now, in theory, of course, stock prices could go up and up and up, but we know because of volatility, etc., that they very rarely go up in a straight line. So you get to that euphoric moment where you're so excited about it, but actually that's the point that people don't really realize. It's probably the point of maximum financial risk. And then as it falls a little bit, you might go through anxiety and denial and believe it's just a temporary setback, still very clever, it's still the greatest investment. But then actually as it falls and falls and falls, you then start to capitulate and just feel, yeah, okay, maybe I made a mistake here and this really isn't for me. Now, ironically, that's the time when actually it could be the most financial opportunity for you in that stock. Now, it's not to say stocks, obviously, and investments can't go to zero, and we do have to be very cautious of value traps. But when something's just moved down so aggressively, and if the investment case hasn't necessarily changed, then we do think that could be the financial opportunity. But actually, a lot of people miss it because of their own emotions. And that really is what behavioral finance is in a nutshell. Now, due to the learnings of behavioral finance, there is a lot of behavioral modification behind this subject and us trying to modify how we think. And I think that's possible to do. You can learn from your mistakes, etc. But I think collectively the market isn't going to necessarily learn. I think maybe individuals can, but the market won't. And I think there's also new concepts that keep getting revised and evolving, that actually the speed of it, possibly we won't be able to completely cure behavioral finance. So moving on to a word about asset allocation. Now in the next couple of slides, we're not going to be able to teach anyone how to create a whole asset allocation as such, but I do want to talk about the importance around it. So I think probably one of the most important terms when we think of asset allocation is diversification. And as Harry Markowitz, the Nobel Prize winner, famously said about diversification being the only free lunch in finance. And what he really meant by that is not having your eggs in one basket. And the idea behind, if you add in new asset classes that behave differently, and that's really important. So the correlation behavioral aspects of different asset classes are different. So you don't want things that are perfectly correlated. If they behave differently, then actually you can reduce your risk without sacrificing too much return. And that's really what we're trying to do with asset allocation. So you want to diversify, you want to bring in new asset classes behaving differently. Now, there is also a term called diversification, and I guess it's a bit of an industry joke, but actually the idea is that you don't put too many asset classes in. It's not a case of you just keep adding and adding and adding further and further, because actually there does come to a point where you don't manage to reduce that risk further. So do be careful of that. And it is also about correlation. So just make sure that everything you're adding does behave differently. Now, if we look at the periodic table in front of us, we can just see, I like to use 2009 as a really good example, where you can see the funny green coloured box, emerging market equities being the top performer. And then just take a little view to the right of the periodic table, where you can see 2010 again performed well, but then actually 2011 it completely bombed out and was the bottom performing. Now, if you'd only added that one asset class to your portfolio, clearly it's going to be an incredibly volatile ride. Now, that's really what you want to avoid. You want to be have a more smoother investment journey. Now, this slide actually comes from JPM, so it's very kind of JPM to do the work for us. But if you look at the white blob, which is predominantly falls around the middle of the periodic table, called the portfolio. Now, JPM have gone away and devised a portfolio for us, and this isn't a recommendation in any way for the asset allocation, but it's just for illustrations purposes. So their portfolio was constructed of 30% developed market equities, 10% emerging market equities, 15% investment grade bonds, 12.5% government bonds, 7.5% high yield bonds, 5% emerging market debt, 5% commodities, 5% cash, 5% REITs, and 5% hedge funds. I sincerely hope that does add up to 100%. So what you can see with the way the white square moves around the periodic table is it's never the top performing asset, it's never the bottom, but actually it's always there and thereabouts, midway or even midway towards upper part. And this really does just go as far to show you that it just smooths out that return. You avoid the best years and the worst years. To be able to expect, to be able to select asset classes time and time again and forecast when they're going to be the best, it is just impossible to do. No one can do it. And I think it's also important to recognize there's always two sides to a trade as well. So you may time it well on the way in, but then ask yourself if you're likely to be able to get out at the right time. So again, if you're in emerging market equities, would you have been able to avoid 2011 had you bought cleverly in at 2009? Indeed, the most likely idea behind it is you probably would have bought in at some time in 2010 following a very strong outperformance and then carried it through 2011. So again, diversification, asset allocation, incredibly important to our portfolio. Now, the next slide really just emphasizes the point a little bit more, but it just shows it in a picture form. So if you had two investments, investment A, investment B, they look pretty much perfectly negatively correlated. If you held those two investments, you can just see what the resulting portfolio looks like in the blue colored line. It's just a much smoother reaction, and that's really, really what you want. Now, I guess I could share with you one kind of asset allocation methodology I've read before, and it's a very simple idea. Now, again, not advocating a strategy, but there's a few points I want to talk around why I think it's important, is the idea of taking 100% of your portfolio and minus your age to come up with your equity exposure. Now, I think this could potentially work well for someone who's building a portfolio and wanting to be a really long-term investor working towards their retirement, because what that does is it controls your equity exposure. So if you're 20, then obviously your equity exposure would be around 80%. And as you go through the course of time, it reduces. And as we know, equities is really where the highest amount of risk, the most volatility we're going to see from equities within the portfolio. So it'll be the dominant part of the variability of the return. So lowering that through the course of time, so we're not experiencing very strong drawdowns in the later part, is quite a useful consideration. The other part about it is, and I'm not necessarily advocating the equity exposure being 100 minus the age, but the other beauty of it, I think, is the fact that it helps you automatically rebalance your portfolio so that every year you're slightly taking down the equity exposure. Now, of course, if you left your portfolio alone for 3 years or 4 years, and if the equity market is outperformed by, say, 20%, then of course you're out of step with your initial asset allocation. So the idea of possibly every year considering rebalancing, I think, is also somewhat a credible investment strategy. It really will help you along your investment journey. But I think the importance to bear in mind is just asset allocation should definitely be tied towards someone's risk tolerance, i.e. their capacity for loss, and time horizon, how long they really want to be involved in the markets. Now, once you have a credible asset allocation exposure in place, what next? Well, the next is really the implementation route. So you've got your assets set up, but how do you invest them? What do you invest in? And I think there's a couple more decisions to be made here. And that really is, I think the first one is, do you believe in active, passive, or do you want to be a blend within your portfolio? And this could be tied into the IPS. So these are decisions possibly you've already made initially, but what are these different terms and what do they mean? So active management is very much looking for a fund that is able to generate alpha or attempts to generate alpha by being different to the market and by being different to an index, taking different position sizes in order to try and generate some alpha. Now, of course, the danger is here that you could end up generating negative alpha, but in the hope that you pay usually a higher fee to generate some positive return relative to a benchmark. Now, passive is kind of the opposite in terms of being more cheap beta. So it's accessing markets as markets are. So pretty much trying to replicate what the market performance is minus costs. But here costs are fairly minimal. They are pretty much reduced. So you are really trying to get the market exposure. And then clearly a blend is a blend of the two. And you may want to think about how you could blend them. If you're not completely convinced by active managers, then maybe a blend is sensible for you. And you could think of maybe something like a 50-50 type blend between active passive, just to reduce those costs. And as we know, costs are certain, so reducing them does help in some ways. The other way you could think about it is maybe core versus satellite. Possibly your passive exposure could be in your core markets, and then your satellite exposure could be with active. And what we mean by that really is that the core part might be the most efficient type market. So typically we always see the US, the North American market, as being a very efficient market, i.e. a very difficult market to outperform. So you may want to consider being passive and then active around the edges. So something like UK smaller companies or some illiquid type asset class could actually benefit by not trying to mimic the index, but actually taking exposures away from that and having a high active share. The next decision really is what type of security suits your preference for your mandate. So when we look at collective investments, there's many different types of ranges, many different types of different investments, and we'll just discuss a few of them below here. So unit trusts and open-ended investment companies are broadly quite similar. And then you've got exchange-traded funds, ETFs, and investment trust ETFs. Now, there's a couple of things we want to talk through the difference, and they are important to understand the difference here. So open-ended investment companies, as they very much sound, are open-ended vehicles, whereas investment trusts are closed-ended. So what do we mean by that? Well, open-ended means that if you're purchasing a fund, if it's open-ended, then what the fund group, the fund manager does is they create new units, or if you're selling, they destroy units. So you can keep buying units and it doesn't affect the actual underlying price of the fund as such. Now, an investment trust is opposite that in the fact that it's closed-ended. So actually what you're doing is buying from someone else on a market, so in a secondary market as such, which does mean it can affect the share price, even though the net asset value may stay the same. So for instance, if there's a popular investment trust being demanded highly, then the share price may move up and may move out of kilter from its net asset value, from what the assets are actually worth. So if it's at a premium, it means you're actually paying more for those assets. And oppositely, if it's at a discount, you're actually paying less for those assets. Now, in simplistic terms, you may think, well, I'll just avoid those at premiums and buy those at discounts. And that's a fair thought, but I do think it's a little bit more complicated than that. We do see trends in the investment industry, and potentially maybe others have researched something and come up with an idea that's meant something is at a premium or a discount for a very good reason. So the net asset value may meet the premium or discount as opposed to the other way around. So it's just something to be mindful of. I guess the other structural difference is that ETFs, which are generally passives, but you can get an active ETF. ETFs are similar to investment trusts in that they're securities, they trade and exchange. So they're actually priced throughout the day that the market is open. Whereas open-ended investment companies are priced at one point in a day. So UK domestic funds are broadly priced at about midday. So i.e. if you're to buy an open-ended investment company at, say, 3 o'clock in the afternoon, you're not actually entirely sure the price you pay, which is what gets priced at midday the next day when you enter into that. So just a few nuances to be careful there, and just decide what is more appropriate for you. I guess the other thing to mention as well is sometimes transaction costs of actually buying these can change a little bit depending on what instrument you select. An OICA unit trust, they're broadly cheaper on investment platforms, whereas ETFs, ITs get treated as securities and can be a little bit more expensive to pay. So if you're going to use those types of investments, you may want to think about upping your minimum lump sum when you buy something, because obviously transaction costs can eat into returns. Now, if you've decided on active selection, on buying an active fund, then I think it's important to consider a few other things. Predominantly, most of my experience in the industry is buying active funds. And what we tend to see actually is that the average investor tends to buy and sell funds at the wrong time. So a bit of bad news there. People aren't actually very good at timing their purchases. So as the chart shows, it's a kind of investment cycle, or a cycle of purchasing. It shows that investors predominantly sell at the wrong time after some poor performance, and then buy at a strong time after strong performance. And actually, as we know, mostly fund managers have inherent styles within their funds, which probably means that for some, it's not actually anything to do with skill in terms of when they underperform or outperform. And it's much more to do where the market is. So if something hasn't necessarily changed, then we're big advocates for not selling just following underperformance, because we've seen it time and time again where performance can turn around. And if you've sold, then you miss out on that return. Now, there are actually different returns in the way funds show their total returns, and most of them are time weighted. But actually, if you consider what the money weighted return is, which normally falls short, it does exactly what I've just explained. It includes the flow dynamic. So actually, when there's more investors in, it puts more of a weight towards its return than when there's less investors. So the money weighted does normally fall short of time weighted. So we can see this is a phenomenon. It's not just theoretical. So what does this mean? Well, it means we need to be cleverer than the average fund buyer. And it means we need an edge when we're identifying well-managed funds. And we also need to eradicate our emotional behaviors. Thinking of behavioral finance again, we need to remove that from the equation. So how does the fund manager selection process work? So predominantly, we spoke about those 3 different collective investment vehicles, and we try and stick to the same type of process within the 3. So we look at our fund manager's philosophy. We want to understand what drives them to be in the market. Why do they think their market is inefficient? Clearly, if they're an active fund manager, they believe there's inefficiencies they can take advantage of. So what are they? We want them to be able to articulate that to us. We want them also to be able to feature that in their process. How does their process take advantage of how they're feeling? We want that process to be repeatable, clear. We want it to be well articulated. If someone can't even describe their process to us, it probably shows they really do have some kind of lack of understanding of what they're trying to do. And the idea that they can repeat it time and time again probably isn't going to happen. Now, when we sit down with fund managers, and we're in a very luxury position that we get one-on-one time with fund managers, we actually go through their portfolio with them. We look at each stock in turn. We can ask them a question about any of their stocks, and they can talk, and we hope they can talk about how it fits into their process. If we start to see a growth manager buying lots of value stocks, we'd start to get worried, and there'd be a lot of red flags or alarm bells ringing in our head that concern us. Now, people's an interesting one as well. We want to consider who's running the fund. Now, I think the interesting thing about this process as well is that it needs to fit into all different types of vehicles, and we just weight the different factors differently. So when we think of people, if we're thinking of an OIC, we want to understand what the fund manager's behaving, what he's trying to do. Is he in a team? Who's important in that team? What analysts make the biggest decisions? But if it's an investment trust, we need to expand that to what the board is doing. We need to understand the board. We need to understand there's diversity on the board, that the board are able to challenge each other and the fund manager. And then again, if we think of ETFs or passive investments, it's actually not normally so much about a star fund manager, but it's normally about a group of people that have to follow a process as such, and we want to make sure that they can do that and there can be good succession planning if there's turnover in a team. And then the performance. What do we do? What don't we do? Well, we're not a slave to performance. We don't follow performance in terms of helping us make a decision. What we use performance in a track record in, and we do want to see track records from managers, but we use that to inform our judgment and make sure that we understand when something will and won't perform. Now, the more difficult aspect of it is understanding the extent of underperformance or outperformance, whether that's what you'd expect. But we should very easily be able to tell whether we would expect something to out or underperform. And then the price, clearly very, very interesting at this point in the time. There's a lot of talk around pricing and making sure that things are priced, I guess, scalable and cheaply. Now, it's certainly not about just going out and finding the cheapest investments, but it is making sure that you get the best value for money. So, we do pay some performance fees on vehicles. We're not a big believer in paying them, but actually some instances it does make sense. And if they're structured properly and if they can align shareholder interest, we don't shy away from them, but we broadly don't like to see them. But if we do use them, again, they need to be structured properly. So high watermarks, managers can't earn double over performance if it outperforms once and then it underperforms, and then the second bout of outperformance, which just gets you back to where you were initially, they can't be charging a double performance fee. We don't like to see that. Now, I think at this point, I just want to stop actually and maybe just explain two terms I've used, which are alpha and beta. So obviously alpha is much more around being able to generate a return that's different to an index. It's being able to generate something extra for your shareholders, whereas beta is much more the stock market as such. So what you would see is a beta of 1 in a stock market, meaning that a fund would be performing exactly the same as a market. So it would share the ups and downs. It would go up to the same extent and down to the same extent. So important terms to understand. But there's lots of places you can research those terms further if you want an added understanding. Right, so once we've decided on the implementation route and what types of vehicles suit us better, and we understand how to research funds, to help us aid us in that researching, where to find information. Obviously, I mentioned the luxury of us in the industry, and as being institutional investors, we can actually speak freely to our fund managers. We sit down with them, so we are in a luxury position that, as a retail investor, you're not likely to get the same type of exposure. But there's definitely places you can learn and you can find facts out, and that will help you on your journey. And there's definitely a lot of education these days around funds and investment markets, etc. So definitely look at places such as Square Mile and Morningstar. They're big research outfits that kick out a lot of research, very understandable manner, try and keep it simple. Morningstar actually powers a lot of the data into our platform as well, but there's a lot of media stuff they do as well as videos, etc. So go have a look around their websites, and you might find some interesting information. Then the next is really read financial papers. Don't shy away. The FT is a great read. May not be for everyone, but certainly kind of thrift through that and find some exciting headlines that could help you in your understanding. Also talks a lot about regulation as well, and that's always important to get up to speed on regulation. But I guess nowadays as well, you can listen to podcasts. AJ Bell do their own podcast once a week. It always aims to look at relevant information and recent information to help people there. So definitely please listen into that. And I guess, you can just never stop learning, even ourselves in the industry. We continually learn all the time. Markets, dynamics are changing, and we need to always be up to speed. So please do read, listen, and try and learn as much as you can. Now, there are some actual places you can go and find official documents to help in your research as well, and these are things we look at, come across our desk, and we definitely research them as well. The KIID, the Key Investor Information Document, and the Fund Fact Sheet. Now, on the next slide, I'll touch a bit more about the KIID to explain that, because I do think it's important. But the fact sheet is something you can get from directly from an investment group's fund house website, and this will talk through who the fund manager is. It will talk through the size of the fund, what the benchmark is. It will look at the exposures as well. So how much, if it's a global manager, a global equity fund, for example, how much is in UK equities. So it'll split out the regional assets for you. If it's a multi-asset fund, it will look at how much is in fixed income, etc. So you can start to paint a picture by looking at these documents, and they're reviewed and come out monthly normally, maybe sometimes quarterly, but you can then start to follow them and build a picture for yourself. So very important document to make sure you're on top of. And then we have our own AJ Bell favourite funds list, which is a list of predominantly around 60 active funds and 15 to 20 passive funds that, you know, we're trying to help by bringing down a huge universe. There's really is about 30,000 different options out there for you. Bring it down, but also actually help you understand as well. It's not just about here's a brilliant fund for you to go and invest in. It's actually explaining it to you as well. So we'll look at the favourite funds list a little bit later, but we do have our own fact sheets, our own reports that we produce that really give a clear, concise message exactly what the fund manager is trying to do, and has its own quantitative information on as well. So please do check that out, and I hope that helps. But as ever, please give us feedback if you feel there's more you need. So understanding the KIID, I promised a couple of words on this. The Key Investor Information Document. This is a really, really important document. It's a legal document as well. It replaces the simplified perspective, which turns out it wasn't actually that simplified in the end. And this is a consistent document which really aims to look at a few things, and the objective and policy. So it'll speak about what the fund, what the mandate is trying to adhere to, give you a bit of information there. We'll look at its risk profile as well, give you a score between 1 to 7 using a prescribed methodology from the EU, which is predominantly the SRRI, which is the Synthetic Risk and Reward Indicator. Now, the way this is calculated is broadly looking back at 5 years past volatility. I guess a word of caution possibly on that. We do think it's a good indicator of risk. However, it is in isolation. So we do need to be careful about that. It is one risk measure. There are many risk measures out there, and we think to build a proper picture of a risk for a fund, we should really be thinking of many different types of risk and bringing that together and understanding the risk profile. Now, one slight flaw of this risk profile is it is in absolute terms. So it tells you what the volatility of a fund is without considering what its index is doing. What I mean by this is it's not relative to the index. So if the index in itself has a period of, say, 3 years of a higher volatility track record, then that actually will have a knock-on effect to the fund most likely. And you can actually see, say, a fund that's prescribed as a 4 move into a 5, but not because the fund manager is necessarily doing anything different. And fund managers really don't manage their fund based on where they are on this risk profile. So just important not to necessarily sell on a movement of the scale, but just to look into that in a bit more detail and understand why something has moved, because it may not necessarily be because the inherent riskiness of the fund has become more risky. It may be a bit more of the market. The other point I wanted to make on this risk reward profile is, again, in isolation for a fund, it makes a lot of sense. But actually what it doesn't do is it doesn't explain any kind of diversification. So if you had 2 kids next to each other and both were a 7, but if they were completely uncorrelated type investments, the actual aggregate result may not be a 7, even though both funds are a 7. So something also just to consider there as well. And the next important section is looking into the charges. So exactly what the ongoing charges will be prescribed here. If there's entry or exit fees, we're certainly not big advocates of paying any entry or exit fees. To be fair, there's not many funds that charge them, but if they do, they can be in the region of 5%, and we really believe that would erode and eat into your returns, so we really wouldn't be willing to pay any of them. But it will also specify any performance fees as well, to be careful of and mindful of. So we think it's a great 2-page document which is laid out in a consistent format, which once you've spent a bit of time understanding it for one fund, will let you compare apples with apples and other funds, and it will be really, really helpful. It is only for UCITS funds that are distributed into Europe though, so you won't find them in other investments, but that still is a huge, vast net for you to capture. What the next thing I really want to talk about is just a few fund manager lessons. what it means, what we've learned over time, kind of key takeaways. And I guess the first thing really is to mention is that sadly, and I feel like I'm the bearer of bad news on this webinar, but a good fund manager is just hard to find. They really rarely exist. If we think of household names, and I can name a few, Harry Nimmo, Richard Buxton in the UK market, Angus Tulloch in Asia, is that there are only really a handful that we know of that are spoken through as household names. And that is because it is very difficult to get a repeatable performance pattern and do well consistently over different market cycles, but for long times. So we know outperforming the market is consistently hard. I mean, possibly, maybe that's also because of our own time frame that we set people. We do look at things quarterly as an industry, and possibly that's just too short-termism. If we looked at things just on a 5-year, and I know that's a very hard concept for us all to grasp, just looking at our assets on a 5-year basis, but we might actually be able to give people more credibility if we did that, if we gave them a longer time horizon and just didn't worry too much about short-term noise. Now, the other thing, and we touched on it in the passive active blend discussion, is, don't just use an active manager if you don't think they can outperform. There are good passive solutions out there. They're cheap, they're low cost. So don't just use an active manager for the sake of it. Really use them if you only believe they're going to do the job of generating you alpha. Don't rely solely on past performance. We mentioned that earlier. Be wary of that. Use that more to inform you rather than just buying on a strong track record. Consider investments that are doing badly. Don't just look at good ones. It can tell you a lot by considering bad investments too. Again, it might just be the market. It might be styles that are out of favor. They may be throwing up the best opportunities for the next 3 to 5 years. Now, the last point, and I would want to harp on about this, is that this is incredibly important. Understand what your manager is investing in before you give them any money. There is absolutely no substitute for hard work here. You do want to understand what your fund manager is trying to achieve. Because I think, obviously, if you don't, then you can be let down and your expectations will not be managed and you'll end up not using them correctly. So do understand what a fund manager is trying to achieve. So portfolio construction, think holistically when building a portfolio. Do think of it as one portfolio. Don't try and think of it in isolation. Invest in a range of investment styles and types. The next slide will cover that a little bit more. But when I talk about asset allocation, it's not just about the mix of equities, bonds, cash and property or alternatives. It is also about styles within asset classes. So don't just invest in only lowly duration type fixed income or just emerging market growth funds. Do try and be diversified by style and type. That is also a form of asset allocation. Consider the risks and unintended consequences within funds. So if funds have done well and that's maybe led you into looking at a fund, but again, don't use just the track record for that. It may be because they had certain risks within them. So you may find 2 funds that have done well, but primarily based because the oil price has done well and the oil price has been correlated to their fund performance. Now, buying those 2 strategies together clearly mean you've got an unintended consequence in your portfolio. So be wary of that. Make sure you're buying different types of funds that are benefiting from different types of underlying drivers. Monitor and review. This is important, but it's fine to monitor and review something on a very frequent basis. There's no issue with that at all. You should understand your investments, understand what's happening within them, but don't lead that into forcing you to make changes on a regular basis. I always try and think about whether something has changed. If nothing has changed from the initial investment case for buying a fund, then just because of a poor patch of performance, that doesn't mean you should go and sell it. And we touched on that earlier, but just really, really do think that through. Before you make any sales, just make sure it's not your emotions or those emotional biases aspects that are telling you to sell that, and actually make sure there's a real reason. Something's changed. It's a different fund manager that's taken over. Something's changed in that fund. The fund is now being run at a much larger aspect, and maybe they're not investing as many of these small caps as they were before, and they've gone up that cap scale, and that's not where their skill set is. Then that means something's changed, and then that's time to take action. This is a picture of the Morningstar Style Box. It's a tool we use. We don't rely on it. It's one tool we use, and it helps to inform us as to whether we've understood a fund. Now, along the horizontal axis, you'll look at the style, whether a fund is value, growth, or core. By value, we mean stocks that look to have the potential to re-rate or maybe earning surprises, whereas growth stocks are ones that are potentially already priced in, but that future growth could help them re-rate further, but are not looking attractive at a pricing point. And then on the vertical axis is much more about the market caps, so small, mid and large. And what we can see here is I've plotted every active UK fund from our favourite funds list. And we can see here we've got a breadth and depth of different types of funds that offer different styles and different market cap exposures. Now, it's tempting to like two funds that sit in the same box, but actually we'd be quite advocates of looking for funds that do very different things and trying to buy into different types of styles. So within the favourite funds, there's a good range of different types of managers. So it's always useful just to consider this tool. And we can also track how they do over time, so we can make sure that our funds aren't moving wildly between boxes and actually stick to the same core knitting of what they were possibly successful for in the past. And that's also an important point of view that we like to consider. And really just wrapping up in the last couple of slides here. But as mentioned, we do have an AJ Bell favourite funds list. You can find lots of information on the front page of that. Will give you a good description of why something is our favourite fund, really what we like about it. We say to ourselves, we should be able to say really 3 bullet points as to why we like a fund. If we can't, we shouldn't be using that manager. And we try and share them with you as well, just so that you get a bit of an insight there. And obviously you can see the fund size and a performance chart as well on that. And then if you click on further, you can see fact sheet, KIIDs and the AJ Bell report I was referring to before. Now, we also launched ready-made portfolios in December last year, so something to give you a helping hand. So if after this webinar you still feel that it's a very complex decisions out there and actually you want some help, then help is on the hand. Now, I would just mention that these are meant to be managed by yourself, so they're suggestions for how to kickstart your investments, but after that, it's your responsibility to rebalance and the ongoing monitoring of them. But they're a good starting position for you to help you and along a few different types of styles and investment objectives of cautious, balanced, adventurous, and an income profile as well for you. I guess lastly, just to sum up, things to remember, fear and greed results in irrational decisions. I think we've covered that today. Think of your behavioural finance. Don't make the mistake that other investors do. Let them make the mistakes. Remember, you're on an investment journey with long-term goals and stick to them. Except you'll make mistakes. Everyone will make mistakes. The future's uncertain. Markets act in funny ways, can become dislocated from fundamentals. Even our fund managers, they make mistakes. To be a successful fund manager, it seems like you only have to make about 60% of your decisions correct. That means you're making 40% wrong. Don't ignore them. Go back, revisit them, understand what you made the mistake from, and try and learn from it. Patience is often rewarded. Please do be patient. Do your research. Again, no substitute for hard work. Do some research. Also, don't be scared to ask questions. Do contact investment groups directly if you own one of their funds. Do ask for a comment on why something happened. Do not be scared at all. They are there to support you as well. And I think also very important is understand your risk tolerance, your tolerance to risk before you invest, before you even make your first investment. Understand how much you're willing to lose before you start to concern yourself. If you've started from the outset with a figure of say 20% that you're willing to lose 20%, when it gets to 10%, don't panic. That was all part of the investment journey, what you considered at the beginning. And be an investor, not a collector. Like I spoke about at the beginning, when I first started, I was just really collecting funds. I wasn't investing. So yeah, don't let your investment universe get stale and think about it within a portfolio. That really concludes the main bulk of the presentation. I would say if you're still daunted by the markets and investing, then please do consider our passive funds. We have 6 passive funds which are aimed at a growth investor across a different risk scale, but also we've launched 2 income funds recently as well. So please do consider them as well for your investments. Now, I come through to the question and answers. So firstly, thank you very much for sending questions to us. Now, clearly, we're not going to be able to get through all of them today, and we'll all try and answer some of them. I can see there's a few about alpha beta, so I hope we answered that, but please do a bit more research if you need to, and if not, come back to us for further information. We'll try and help there. Another theme that seems to be coming through is very much on the idea of timeframes and how long people should be patient for when they invest. I mean, broadly, we say about 5 years. You shouldn't really even consider investing in the markets if you don't have a sensible time frame of around 5 years. Investment cycles seem to be about 7 years, but we think you should really think about 5 years as a time frame. Definitely nothing shorter. Possibly just looking through the questions a bit more, cost seems to come up as well. So ongoing charges, how much should I pay for a fund? Well, I guess the good news is that fund investing is broadly getting cheaper and cheaper. It's never going to become completely free. But, you know, as we said before, we do think in some instances you should pay up for quality. You know, don't just invest in the cheapest assets. We don't think that's a winning investment strategy. But I think broadly, most ongoing charges are around kind of lower than 1%, I'd say. So I wouldn't be looking at something over 1% as such. A follow-on question is about transaction costs, actually. Transaction costs aren't included on the ongoing charge. And there's been quite a lot of news around this in the last couple of years as this was brought into regulation, that each fund manager, fund group had to demonstrate what their transaction costs. It actually caused a lot of confusion at the beginning as well, as there were different types of methodology on how to calculate that transaction cost. So we couldn't even really compare transaction costs by funds. Even some of the fund managers didn't even know what they were either. And I guess there's two further points to conclude with, is that we were seeing negative transaction costs, which is clearly impossible. And that was very much because of a term called slippage, where actually they were using within their method the price of a transaction from a different time. So when it was being priced actually when they went in. So that was quite unhelpful for us to understand. So it is quite complex, but we're hoping that future regulation will make it easier to understand. But I think maybe the last point about transaction costs is that we've always been paying them. They're not a new thing. They've always been in the return. So don't be too scared of them, but it is good to get a better feel in this day and age for what we're paying. Because also, you know, you can have a low ongoing cost but a very high transaction charges, and then the flip side are high ongoing costs with low transaction charges, where you might have thought on the outset one fund was expensive, but actually when you aggregate them together it's the cheaper option. So do be careful with costs. Had other questions coming through as well about how many funds to build in a balanced portfolio. I guess as with any investing, there's no such magic formula, sadly. I think in some ways it is up to someone's own preference, how much stock selection or fund selection risk they're willing to take on. Clearly 10% of one fund in a portfolio is going to be a dominant driver. That's broadly the limit we look at. We think about 10% is the limit of what we want in our portfolio. I mean, the key for me is not necessarily how many lines you have within your portfolio, but just really trying to make sure that each line, each fund does something different. It needs to be additive to the portfolio holistically. Otherwise, you could be diversifying away a return and you'll get funds acting in the same manner at the same time, which is definitely not what you want. There are plenty of questions, and I'm sorry we can't answer them all in this format, but please do look to the feedback form and include some there if you want some answers for us to come back to you. We'd be happy to at a later date. I guess lastly, just thank you very much for listening and having the patience to stick with us for around the hour. We hope you enjoyed the webinar, and we hope you managed to get something from it. Also on the feedback forms, please do give us feedback about what you'd like to hear in the future. I think we covered quite a lot today, so it was quite a broad discussion. So if you actually want to focus on in some of the issues on a separate webinar with focusing in a bit more detail, then we can definitely do that. But please do give us feedback of what topics you would like to focus on. So thank you very much for listening. Have a lovely day, everyone. Goodbye.